Hello everyone, welcome to the Stock Trading Tutor channel. If you would like to create a free Demat account, click the link in the description and fill out your details. Now, let's look at the forward earnings of a company, which is required for fundamental basics. What are forward earnings? Forward earnings are forecasts made by analysts to estimate the future financial performance of a company. Unlike trailing earnings, they are based on projections of future earnings. As a result, they may not be very accurate. However, forward earnings are used by analysts in order to calculate the forward price to earnings ratio, which is the PE ratio. Now, what is the PE ratio and why is it important to analysts? The PE ratio is a very useful tool to identify how expensive or cheap a particular item is at any given point of time. A high PE ratio means that there are big expectations from the company in the near future, and in case the company does not live up to these expectations, the stock price of the company drops over time. What are trailing PE and forward PE ratios? When the PE calculations, that is the forward earnings ratio calculations, are based on the past earnings, it doesn't take the future growth potential into account. Since investors are more interested in the future prospects of a company, the future PE ratio is calculated. And while they may not be as accurate as the trailing PE ratios, they are more relevant to the investor when it comes to valuations. Now, how to calculate the forward price to earning ratio? The forward PE ratio is calculated as follows. You have to first take the current share price and divide it by the estimated future earnings per share. Here, the earnings per share is based on the earnings of the next 4 quarters. Let's take an example to get a better idea of the concept. Suppose the current price of a stock is rupees 50. The projected earnings of the next 4 quarters is rupees 60 crores. And the number of shares outstanding for the company X is rupees 40 crore. Now, the earnings per share is equal to 60 crores divided by 40 crores, which gives 1.5. So the forward PE ratio is 50 divided by 1.5, which gives 33.33. Now, things to remember before about the ratio. The PE ratios differ for different companies and sectors. So, when evaluating the PE ratio of a company, find the companies that operate in the same sector for better analysis. When the earning per share of a company is expected to grow in the future, the forward PE ratio would be lower than the trailing PE ratio. Similarly, when the EPS is expected to drop in the next 4 quarters, the forward PE ratio would be higher than the trailing PE ratio. Thank you for watching this video. For more videos on stock market and trading, please subscribe to this channel. If you would like to create a free Demat account, click the link in the description and fill out your details.